Growth investors frequently argue they've got an advantage over those who are more value-oriented because they're buying into companies with cutting-edge technologies that have done more in terms of advanced systems development and product designs. But looking back at history, what's new seems to be quickly become old, as competitive free markets tend to level the odds over time, at least a bit. Along these lines, we're here today with Wes Crill, Dimensional Fund Advisors, Head of Investment Strategists. He has written extensively about such movements between growth and value style stocks over the years. This includes a piece documenting a change in style categorizations in the Russell indexes for some big name tech stocks that once were considered as growth stalwarts. Hi, Wes. How are you doing today?
Doing well, thanks. Thanks for having me on today.
Sure. Please tell us what you found over the years and more recently, and how do you look at this changing landscape?
I think as a general trend, and this is something that we've seen using 96 years worth of data in the US stock market, where companies that end up in the top of the market, the largest firms in the US economy, tend to have stellar returns along the way. After all, that's how you get to be one of the largest companies in the world, is you had really great returns and grew your market capitalization. What might be surprising to some investors is that once they get there, they tend to have very average returns. And in fact, if you look at their returns versus the market, after joining the top 10, on average, they really just deliver about market-like returns from there on. And it's not that they suddenly became less successful as companies. In fact, if anything, if they're staying at the top of the market, they likely did continue to be successful as investors expected. But this is where the really key distinction comes in between a good company and a good investment. A good company is one that investors probably expect to continue to be very profitable. Maybe they have some sort of moat in terms of their business model that leaves them somewhat unassailable in terms of continuing to deliver high profitability. If I look at that type of company and I'm an investor, I'm going to be willing to pay a very high price. I probably assign a low probability of that company going bust in the future. And so I'm going to apply what's known as a small discount rate on a relative basis to their expected future profits. That is not the same thing as a high expected return. A high expected return is when investors are discounting a company's future profits more heavily. And that means they're going to have a low price relative to those fundamentals. That's what we mean by a value company. And so when we talk about a good expected return for an investor, that is not the same thing as a good company, because in many cases, that's going to be a lower expected return stock.
Okay. And that's where your process at DFA really hones into what is the best stocks in terms of expected returns.
Yeah, we use it as one of the many inputs or one of the many signals for markets that tells us about which stocks have higher expected returns. You're looking at components, by the way, this is all from just valuation theory. It's sort of like when you go car shopping and I evaluate which cars are going to deliver the best return for my purchase, looking at, what's the brand, the make, model, the mileage, the trim level. And then I'm combining that with the information on how much I'm paying. And that's the same thing we're doing with stocks, right? So we're looking at variables with information about the price. So the market capitalization, the relative price characteristics, so price scaled by a fundamental, and then profitability. That gives us information about what the expected future profits are for that company. And we're using all those together to then overweight within a portfolio or within a region or country, overweight stocks with higher expected returns. And that allows us to increase expected returns over the market that, again, is not taking a bet on where the market's going to go. It's simply using the information presented to us in market prices.
Well, one of the concepts that I think a lot of people struggle to understand is fair price. What is meant by fair price? Is there a fair price, and how do you come to that valuation? And could you explain a little bit more about fair pricing?
Yeah, and a fair price is really an outcome of a highly competitive market. It means you have lots of people who are making an assessment about what's going to happen to this company, about how a company's future cash flows are going to respond to what they believe is going to be the economic climate, volatility in markets, really anything that's relevant for the performance of a company. And at that point, the price of that company settles in to a level where you have investors who are willing to buy that security, you have investors who are willing to sell that security. and they kind of balance each other out such that no one has an unfair advantage when it comes to predicting whether that price is too high or too low. Now, with the benefit of hindsight, you were always going to find examples where that price was too high or too low. It's not saying that this price is right. It is saying that no one is going to be able to figure out when and in what direction is the important aspect. Not going to figure out which in what direction, which prices are incorrect until you have the benefit of hindsight. And so a fair price means that you were better off using that price rather than trying to outguess market prices or try and time them.
And that's where expected returns plays such a key role, correct?
Yeah, that price is essentially telling you, when you combine it with information about company fundamentals, what the rate of return is that's being demanded by market participants. And so they're saying, I'm getting X level of cash flows in the future. I'm willing to pay Y price today. Well, the gap between those, assuming that today's price is going to be lower than the expected future cash flows, it's telling you that they are demanding a rate of return to invest in that company. And that's really where this idea of an expected return comes from.
Okay. Okay. Well, thank you very much for your time today.
Yeah, thanks for having me.